Ladies and gentlemen, welcome back to the channel. We have a lot of news to get into today, as well as some surprising economic data. Ladies and gentlemen, let's get into all of this information. I don't want to waste too much time with the intro today. You guys know the deal. Hit that like button, subscribe to the channel, and check out that link down below in the description of this video. If you want to come find small cap AI stocks and invest in those with us, don't be a jackass though. Remember, if you blindly copy anyone, you could lose all of your money. Hell, you might end up living under a bridge. You know, you got to know the companies you're investing in, because the second they're red, you're going to panic and freak out. And then the next day later, we're going to get rich. And that's not a good scenario to be in. It's called a doom spiral, where you start revenge trading. Seen it happen before. It's a terrible thing. Check it out, though. Link down below in the description of today's episode. Let's get into today's video. Now let's get into the broader market economic data today. So we did get a lot of data today. Tomorrow is going to be like the main day of this week, but today was also huge. So you had challenger job cuts that came in at about 86,000. Last month was 62,000. The expectation was 89,000. So what challenger job cuts are is planned layoffs. So we came in lower than expected. Still higher than last month, but lower than expected. Okay, so that's technically a beat. The ADP employment change last month was revised up from 104,000 to 106,000, but we came in at 54,000. The expectation was 65,000. So not terrible, not like things are collapsing out there, but we did miss expectations by about 11,000 jobs versus the expected 65,000 jobs. So this is the private payroll number. It did come in a little bit weaker than expected. The balance of trade came in at negative 78.3 billion. The expectation was negative 75.7 billion. So this does raise your GDP estimates a little bit, okay? Or it should help keep them stable. Q3 GDP, the latest estimate is 3%. That is unchanged from September 2nd. So it didn't technically change anything, but it does change things a little bit. You can see real personal consumption expenditures growth went from 1.7% to 2.1%, and real gross private domestic investment growth went from 5.3% to 6.0%. Okay, so these are the two most important metrics to really evaluate the economy, in my view. Like real personal consumption expenditures. Are people spending more? Is there actual growth in spending? That's important. And are companies investing domestically in America? The answer is yes and yes. From that perspective, the economy is doing just fine. Now, back to the economic calendar, because we did get ISM services PMIs. Now, this is where some of the surprise came in. Your services PMIs, the headline number came in at 52. The expectation was 51, so that was a headline beat. Business activity came in at 55. The expectation was 53, so that was a beat. Employment came in at 46.5. The expectation was 46.2. That was a beat. New orders came in at 56.0. The expectation was 50.1. That's quite a large beat. But look at this. ISM services prices. The most important metric of this, the inflation metric, came in at 69.2. The expectation was 70. Last month, you were at 69.9. Again, you came in at 69.2. So you came in lower than last month and lower than the expectation. For services prices, that is huge. Okay, so we kind of got the best possible scenario here, where business activity came in good, employment came in good, new orders came in good, prices came in low or lower than expected. Best case scenario, I think markets should have actually taken this as really good news today. Okay, I think if it wasn't for the weak September seasonals, this would have been a big positive catalyst for the markets. okay? And that's where some of the surprise comes in today because nobody was really expecting that, okay? Now, for tomorrow, we have non-farm payrolls expecting about 75,000, and the unemployment rate is expected to rise from 4.2% to 4.3%. I've talked about this before here on this channel over the past week, but again, when I think about this logically, like I have no other insider information, like I have the same information as you do, but Trump fired the head of the BLS because he said last month's jobs reports were basically inaccurate, okay? Well, Trump's gonna look pretty, stupid, if you will, if we get a really low jobs number tomorrow. Like, that is not in his best interest to get a low jobs number. Then who do you blame it on? Right? You can't just blame weakness in the economy on the new guy you appointed, right? Like, it's not going to be a good look if that comes in really bad tomorrow. So I think the odds are we could come in with a higher jobs number, just from that perspective. Now, I do want to tell you, though, and I've talked about this on the channel for years now, the economic data is very delayed. So what we're seeing in real time in the economy is a pretty stable economy, growing a little bit, not really changing. There hasn't been a big change out there, okay? What some of the weakness we're getting reported in the data, like ADP employment change, like Challenger job cuts, some of the overall weakness, in my view, really happened months ago. I think that was with like the tariffs, like May, June, like got a little bit of weakness. Companies got a little hesitant. Now that's over with, right? We're back to really like a status quo economy. Nothing is really changing. So the point is I'm making here, this data's supposed to be for August. It's really for like June, in my view. Well, as we get to like October, November, December, we're going to start getting the actual job numbers for, July, August, September, that are going to show the status quo economy that is not weak, not coming in at 19,000 jobs, right? Like not coming in at 10,000 jobs or whatever the last 2 months were, this pretty normal economy. So if I'm correct there, who knows what the number is for tomorrow, but we should see pretty good jobs numbers after this month. Okay, September, October, November, specifically October, November, December, you should see the labor market reflect, 2 months prior, which I think was getting past some of the tariff uncertainties and tariff worries, okay? Because the tariff situation and the trade embargo we had momentarily with China, as I said on this channel at the time, it could have caused a depression. Like literally, like skip recession, go straight to depression, right? That's the kind of scenario we were setting ourselves up with. Like I honestly thought if the trade embargo were to last like a long time, like months, 6 months, something like that, we would be in a depression, not just a recession, as a lot of people were talking about. Well, that ended so fast that it was a shock event, but it didn't cause people to panic because it didn't last long enough. And that didn't give us a recession. You don't just fall into a recession these days. I want to be very clear about this, so nobody like loses their money, like panics and freaks out, okay? Recessions are caused by shock or panic events. Now, the economy today is so diversified, it takes a lot to get multiple industries and multiple sectors and consumers by and large to panic. It just takes a lot. And that's why we don't go into recessions too often these days, because you don't get that panic very often. Okay? And I don't think we're heading down that road anyways. Yes, I think the jobs data is lagged behind, so we're not getting the best real-time information. But in real time right now in the economy, we are not in a recession. So if my theory is correct, over the next 2 to 3 months, you should see the jobs market, labor market really start to stabilize. To what level that is, I don't know. Probably around 70, 80,000 jobs a month, something like that could be what we deem stabilization. We're not going back to 200,000 plus jobs a month. Okay? We don't need that to keep the labor market okay. That's just my take on this whole thing. So basically, whatever happens in September, if we get markets that come down and people get fearful, I don't think it's going to last. Fed Williams says today the standing repo facility stands ready to help manage liquidity issues if needed. This is something we talked about in the last video, but the reverse repo market basically is collapsing. Okay, it was at about $21 billion yesterday. Let's see where the number is today. Yeah, it's at 17.92 billion. Like, it's really bad. Okay, so back in 2019, briefly, this money dried up and nobody showed up to bond auctions. So what happened in the reverse repo market is rates went from like 5% to like 10% overnight. It was a big problem. Okay, well, the Fed had to step in and start providing liquidity, like buying bonds. Okay, well, that's basically what Fed Williams is saying. If liquidity issues arise, the Fed will step in, which would be very positive for stocks. Anytime the Fed buys assets, tends to be a green light for equities. Elon Musk says that Tesla will likely remove the safety driver for its rides in California by the end of this year, so going fully autonomous. Fed Williams says there's still a very high level of reserves in the financial system. Fed Williams says, I don't see abnormal moves in the bond market. Fed Williams says the bond market is more focused on economic fundamentals right now. Fed Williams says the Fed needs to keep the economy on track and allow tariffs to pass through. Fed Williams says, I expect tariff impacts to play out into the middle of next year. I do not think that's the case. I think we're going to have the effects of tariffs, if we have any pass through at all, by the end of this year. I don't think that's a 2026 event. Fed Williams says, my base case is that tariffs will stay in place, but I do consider different scenarios. Fed Williams says core goods inflation has shifted higher on tariffs. Fed Williams says the overall trend in services inflation has been favorable. Again, today we had ISM services prices, which is the inflation component of services, that came in lower than expected. Now, I want to be clear, the PMI is the Purchasing Managers Index. So when you see ISM services PMI, Purchasing Managers Index, it's not hard data. It's a survey of managers in the services sector of large firms that give their expectations about what's to come, right? So the managers in the services sector of this economy don't really think we're going to have an inflation problem versus last month. Their expectations calm down a little bit, which expectations tend to precede reality. If everyone's expecting something, it tends to happen. Vice versa. If they're not expecting it, then it doesn't tend to happen. Williams says, my concern is that the job market cools further than desirable. Again, he's now leaning towards, hey, we should cut rates. So if we look at the odds of rate cuts today, because they move around on a daily basis, the odds are falling a little bit, but it's almost a surefire that we're going to get a rate cut September 17th. There's a 94.4% chance of a rate cut. And it's probably moving around a little bit today, just pricing in what could happen with the jobs report, right? If we get a really hot jobs report tomorrow, like 200,000 jobs or something, the odds of a rate cut are going to fall. But it's going to take more than that even, I think, to not get a rate cut in September. Now, for October, you're pricing in another cut at 54.4% odds. And then for December 10th, it's kind of split between only 2 cuts this year and 3 cuts this year. 2 cuts priced at 45.9%, 3 cuts priced at 41.5%. Based on tomorrow's jobs report, it's really going to either help solidify that third cut this year or push those odds further, lower. Fed Williams says it is clearly the case that downside employment risks have increased. It says President Macron says if Russia continues to reject peace talks, there will be new sanctions in coordination with the U.S. U.S. CEA's Moran says if I were nominated to a Fed term over 4.5 months, I would resign from the CEO or CEA. Fed Williams says tariffs likely to add 1 to 1.5% to inflation this year. Fed Williams says I expect inflation to get back to the Fed's 2% target in 2027. Fed Williams says it will become appropriate to cut rates towards neutral. And Moran says that tariffs aren't inflationary. Mexico is considering new tariffs on countries without a trade deal. This looks like it would include China. Canadian bilateral trade minister says Canada is still hoping for relief from U.S. tariffs on steel, aluminum, and autos, and that work continues. Moran says that Trump's variety of policies is quite disinflationary. Goldman lowers Q3 GDP forecast to 1.6%. Japan's chief trade negotiator says, I am going to have talks with U.S. Treasury Secretary Bessent, U.S. Commerce Secretary Lutnick, and U.S. Trade Representative Greer. Bank of America investors say that the biggest tail risks are trade war triggers global recession at 29%, inflation prevents Fed cuts at 27%, disorderly rise in bond yields at 20%, AI equity bubble at 14%, and dollar debasement at 6%. That's kind of wild. These odds are crazy. A White House official says Trump also emphasized that European leaders must place economic pressure on China for funding Russia's war effort. Most recent AI investor sentiment shows another uptick in bullish or bearish investors. Bullish investors fell from 34.6% to 32.7%, so fell about 2%. Neutral investors fell from 26.0% to 23.9%, and all of the rise came into the bearish category from 39.4% to 43.4%. So people are bearish, very bearish, which is a good thing. If you're a bull, that means the market rally likely has a lot of legs to continue higher. Again, remember that once everyone is bullish, that's when the party tends to stop. If people are bearish, that's actually a good sign. Now, the CNN Fear and Greed Index is neutral at 51, so almost as neutral as it could get. Market momentum is neutral. Stock price strength is greed. Stock price breadth is greed. Put and call options in greed. Market volatility is neutral. Safe haven demand in greed. And junk bond demand is currently in greed as well. If we take a look at the percent of stocks trading above their 50-day moving average, even though we have seen some weakness in recent days and weeks, you're still holding up quite well. 58.77% of stocks are trading above their 50-day moving average. I like to point this out because before you get a larger decline in markets, before you get like a 10+% decline, normally you see the bottom end of the market start to fall out first. And you're really not seeing that right now. Again, I think it's a toss-up. Like, September's probably going to be a bad month, but I think you're looking at some real strength into the end of this year. Hopefully we get some trade deals done. Hopefully the economy stabilizes, inflation continues to make downward progress, and AI is going to be a main focus along with rate cuts into the end of this year. But it's very important. Let me literally overemphasize this again. It doesn't matter if we get rate cuts. It matters why the Fed is cutting rates. If the Fed is cutting rates because the labor market or the economy is presumably weakening too much, that's not a positive rate cut. If we get rate cuts because they want to prevent weakness, that the economy is still doing okay, but they don't want it to get worse, then that is a good rate cut. So not all rate cuts are bullish. I think that's important for people to understand. So let me know your thoughts on all of this down below in the comments section. Ladies and gentlemen, hit that like button and subscribe to the channel if you have not done so already. S&P up 0.43%, NASDAQ up 0.5%, and the Russell is up 0.5% as well. The Russell actually looks really good, like it wants to break out here. The S&P, NASDAQ look, kind of neutral in my view. S&P looks a little bit better than the NASDAQ, but the Russell looks like it wants to make another leg higher. So let me know your thoughts on this down below in the comment section. Come join the trading community if you would like to be a part of the action over there, where we are going out finding small cap AI stocks before Wall Street does. I have invested over $100,000 into one single stock that I think is going to make well over $1 million. That is a hidden gem in my view. But again, if you invest your money blindly because someone else is, you're going to lose all your money. Maybe end up homeless under a bridge. Just for dramatic emphasis here. Have a great rest of your day, and I will see you in the next one.